wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This here is the Market Color Podcast, where we keep you informed on the latest developments in the financial markets. And we do that by first giving you a broad overview of the global markets, so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week, so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 163, and in this episode, we are reviewing the performance of the global markets during the 23rd week of 2025, and that is from Monday the 2nd to Friday the 6th of June. And without further ado, this is your host, Jamuhuri, and together, let's dive right in. We kick it off in the United States, where the Organization for Economic Cooperation and Development has further cut the economic growth forecast for the United States on the back of President Trump's erratic tariff policies that continue to create uncertainty and weigh down the outlook for the global economy. The growth outlook for the United States was revised downwards from 2.2% to just 1.6% in 2025. Meanwhile, global growth is projected to slow down from 3.3% in 2024 down to 2.9% in 2025, and this is on the assumption that the current tariffs are sustained despite the ongoing legal challenges. And in related news, on Monday, Jamie Dimon, who's the CEO of JP Morgan Chase, has once again sounded the alarm that the US bond market was in danger of cracking if the United States does not regain control of its public finances. The reason for the warning is based on an ever-increasing U.S. budget deficit, which is projected at 7% of the country's gross domestic product in 2025, and which in turn feeds into the national debt, which is now approaching $37 trillion. The JP Morgan CEO accused the U.S. of disastrous fiscal management and controlled debt and massive deficits caused by completely unrealistic tax and spending policies. The comments from Dimon come after the U.S. House of Representatives recently passed a tax bill that is likely to add another $2.7 trillion to the deficit over the next 10 years. Staying in the United States, where a stronger than expected growth in jobs and a stable unemployment rate underlines the resilience of the U.S. labor market in the face of increased uncertainty due to tariffs. The Bureau of Labor Statistics reported on Friday that hiring decreased slightly in the month of May, even as consumers and companies braced against the impact of tariffs and a potential slowdown in economic activity. Non-farm payrolls rose by 139,000 new jobs in the month of May, which was slightly above the Dow Jones estimate for 125,000 new jobs and was a tad bit below the downwardly revised number of 147,000 new jobs that were created in the previous month of April. Meanwhile, the unemployment rate held steady at 4.2%, whilst a more encompassing measure of unemployment also remained unchanged at 7.8%. Over to the Eurozone, where flash data that was released by Eurostat on Tuesday showed that inflation in the Eurozone fell below the European Central Bank's target rate of 2%, as it came in at a cooler than expected 1.9% in the month of May, mainly driven by a sharp decline in services inflation. Economists polled by Reuters had expected the inflation reading for May to come in at 2% flat compared to the previous month's inflation rate of 2.2%. Meanwhile, core inflation, which excludes food and energy prices, also eased off as it fell from 2.7% in April down to 2.3% in May. Staying in the Eurozone, on Thursday, the European Central Bank announced a 25 basis point reduction in its policy rate as it lowered its inflation expectations on the back of a stronger euro and lower energy costs. According to LSEG data, traders had fully priced in this reduction, which now takes the deposit facility rate down to 2%. For your information, the deposit facility rate is the rate that the European Central Bank uses to transmit its monetary policy stance. In its official statement, the Governing Council said that the decision to lower the deposit facility rate was based on its updated assessment of inflation outlook and the dynamics of underlying inflation, as well as the strength of monetary policy transmission. On Wall Street this past week, stocks jumped on Friday after the latest non-farm payrolls data came out better than expected, easing concerns that the economy was slowing down due to the introduction of trade tariffs. A series of data released earlier this week signaled a possible economic slowdown and raised questions about the impact of tariffs, as well as the next policy step for the Federal Reserve, which is scheduled to meet on the 17th and 18th of June. The market's move higher was supported by Tesla shares, which recovered by about 3% after tumbling more than 14% on Thursday as its CEO Elon Musk sparred with President Trump on social media. The blue chip Dow Jones Industrial Average popped up by 443 points to close at 42,762, whilst the S&P 500 gained by about 1% before finally settling at exactly 6,000 flat. Meanwhile, the Nasdaq Composite rallied by 1.2% to end the week at 19,529. In the U.S. government bond market, Treasury yields spiked on Friday, driven by a hotter-than-expected U.S. jobs report as investors breathed a sigh of relief that the U.S. economy remains on solid footing. Non-farm payrolls rose by 139,000 new jobs in the month of May, and this data can provide insights into how companies have changed their hiring outlook on the back of President Trump's erratic tariff policy. A better-than-expected jobs report can also provide justification for the Federal Reserve to keep interest rates on hold for a little while longer. The Fed Fund futures contracts are now pricing in 100% likelihood that the U.S. Central Bank will put its policy rate on hold at its next meeting in mid-June. The yield on the 2-year Treasury note rose more than 11 basis points to finally settle at 4.04%, whilst the yield on the 10-year Treasury bond also added 11 basis points and came to a close at 4.50%. For your information, 1 basis point is equivalent to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall and vice versa. In the commodity markets, the price of crude oil rose more than $1 a barrel on Friday, with oil prices on track for their first weekly gain in the past 3 weeks after a favorable U.S. jobs report and resumed trade talks between the U.S. and China raised hopes for growth in the two largest economies. The oil market continues to swing with the news on tariff negotiations, plus data showing the impact of U.S. tariffs as they flow through into the global economy. On a weekly basis, both benchmarks were on track to settle higher after declining for 2 consecutive weeks. The price of the global benchmark, Brent crude, advanced by 2.75% this past week to close at $66.62 a barrel, whilst the price of the U.S. benchmark, West Texas Intermediate crude, this rose by 4.9% during the week to end at $64.71 per barrel. In the precious metals market, the price of gold slipped more than 1% on Friday after a stronger than expected U.S. jobs report reduced the prospect for an imminent rate cut by the Federal Reserve. Based on trading in short-term interest rate futures, the Federal Reserve is expected to cut its policy rate by 25 basis points in September, with a possibility of another rate cut in December. On the trade policy front, there was little direction on the way forward after the highly anticipated call between the U.S. president and the Chinese leader on Thursday. Gold is considered as the ultimate safe haven asset and is traditionally viewed as a hedge against inflation and economic uncertainty, and tends to perform better in a low interest rate environment since it doesn't provide a regular yield like a bond. The price of spot gold fell by 1% on Friday, but was still up by 0.8% for the week and eventually came to a close at $3,316 per ounce. In the cryptocurrency market, the United Kingdom is set to lift its current ban on crypto debt securities in a bid to catch up with the United States as it looks to position itself as the global hub for digital assets. On Friday, the Financial Conduct Authority, which is the UK's main regulator for financial services, announced a proposal to reverse its ban on offering crypto exchange-traded notes to retail investors. For your information, exchange-traded notes are a type of debt security that is linked to one or more specified assets, which in this case would be cryptocurrencies. In essence, these notes allow investors to gain exposure to digital assets through the use of a regulated exchange. The sale of crypto exchange-traded notes to retail investors has been prohibited in the UK since 2019 due to concerns over the higher risk and the potential for losses associated with digital assets. We now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where during the past week, the Kenya shilling continued to trade within a very narrow range versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.22 compared to 129.26 that was recorded the previous week. Meanwhile, the sterling pound was priced at 175.06 and the euro was valued at 147.45. And on the regional front, one Kenya shilling was changing hands for 28.17 Ugandan shillings and 20.74 Tanzanian shillings. And to the Rwandese franc, it was posted at 10.96. The Kenya shilling continues to trade within a narrow range versus the US dollar, and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves increased for the third week in a row, and yet again by a significant amount of $122 million for a grand total of $10.58 billion, which is equivalent to 4.7 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. Please note that in its weekly bulletin, the Central Bank of Kenya does not provide any explanation for the change in foreign exchange reserves. In the money markets, during the past week, the interbank market remained sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the interbank market. The average interbank rate, which is the rate that banks use to lend to each other, mainly on an overnight basis, this dipped by 6 basis points to 9.76%, compared to a rate of 9.82% the previous week, and was still pretty much in line with the central bank rate at 10%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 18.5 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. Staying in the money markets, the average yield on the top 5 money market funds in Kenya decreased by about 10 basis points to close the week at 13.3%, down from 13.4% that was recorded the previous week. The highest interest rate was offered by Gulf Cup Money Market Fund at 13.9%, whilst the lowest rate was offered by Equity Money Market Fund at 5.4%. Meanwhile, the ZD Money Market Fund, which is a Safaricom product and is available through your M-Pesa app, was offering a rate of 7.1%. For your information, money market funds are considered a low-risk investments because they mainly invest in short-term government securities such as treasury bills. One of the key benefits of money market funds is their liquidity, which means that you can withdraw your money relatively easily. When selecting a money market fund, besides the rate being offered, please consider other factors such as the fund's historical performance, the reputation of the fund manager, as well as the fees and commission charged, and also the underlying assets in the fund. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 5th of June, and the central bank received bids totaling to 61.4 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 256%. The central bank ended up accepting a total of 57.3 billion shillings, and the results of the auction were as follows. The 91-day rate ticked lower by 1 basis point to average out at 8.28%, whilst the 182-day rate declined by 2 basis points to settle at 8.54%, and the 364-day rate was marginally lower as it came out at 9.99%. Up next is our topical issue, and this week we are looking at the central bank survey showing that Kenyan banks are ready to offer crypto transactions. On the back of increased adoption, nearly a third of Kenyan banks are ready to start facilitating cryptocurrency transactions as the country works on regulations for virtual assets. The Central Bank of Kenya Innovation Survey for 2024 shows that 31% of commercial banks indicated that they were highly likely to undertake transactions involving virtual assets, which includes cryptocurrencies such as Bitcoin and Ethereum. The findings signal a shifting view for commercial banks as the adoption and usage of digital currencies continues to increase across various sectors. The central bank said that financial institutions indicated their interest in virtual assets, noting their potential to enhance financial access to the unbanked by providing alternative payment and investment channels, as well as improving transaction speed and reducing the cost of transactions. Banks have been missing out on revenue from virtual assets on the back of the central bank barring them from facilitating such transactions, even as multiple reports showed a growing uptake of digital currencies. Currently, Kenyan banks are barred from facilitating transactions in digital assets, which denies them an opportunity to earn revenues from such transactions. A report by the International Monetary Fund that was released in January 2025 showed that during times of dollar shortages in the domestic foreign exchange market, a number of Kenyan companies were making regular use of stablecoins such as USD Tether as a means of payment to settle contracts with foreign suppliers. Meanwhile, another report by Chainalysis titled The Geography of Cryptocurrency showed that Kenya was ranked number 21 out of 155 currencies on the Crypto Adoption Index and number 3 overall in terms of peer-to-peer exchange trading volumes. In addition to that, a 2017 research by Citibank estimated that the volume of Bitcoin holdings in Kenya was valued at 2.3% of the country's gross domestic product. However, since then, there has been a policy shift within the government, with the National Treasury publishing the draft National Policy on Virtual Assets in January 2025, in which it seeks to formulate regulations on the use of cryptocurrencies and digital tokens in the country. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. For more information on how to become an active subscriber, please check out our support link at buzzsprout.com /1999543 /support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories. That is Apple Podcast, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamuhuri@gmail.com. Jamuhuri spelled JAMUHURI. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, the people who are crazy enough to think they can change the world are the ones who do. Quote by Steve Jobs. Think about it. Thank you, and God bless.